Aloha YouTube, we are back with another Invest in Myself video. And I know it's Saturday when I dropped this video, and I do apologize. But there was a quick real estate deal that I had to just jump on. So that's why this is being posted a little bit late. So I truly do apologize. But you know, man, I'm trying to get this passive income, quit the 9 to 5. You know what I'm talking about. So go ahead and do me a quick favor if you have not done so yet. If you are new to the channel, go ahead and hit that subscribe button. Go ahead and stimulate the like button and put a comment down below once you finish the video as well. This really does help me reach a wider audience base. And I truly do appreciate you guys that subscribe and take time to even hit that like button for me. But anyway, I'm gonna make it up to you guys because this is a very interesting video. We will be velocity banking and paying off debt with my next client. She's from the Aloha state. So without further ado, go ahead and get your pen and your pad out. We are gonna hit this whiteboard real hard and we're gonna start velocity banking in the Aloha state. And before we get into velocity banking with Coco, I just wanna go over a concept that a lot of people do, not knowing that it's actually losing them money. So this concept is pretty much saving for an emergency fund while you have high interest debt. So we're just gonna kind of go over the facts of how Coco has her stuff broken down, and we've talked about it, and she has since switched this. But let's go over the facts. So Coco has a Hawaiian credit card that has a total debt of $2,925.72 with an interest rate of 25%. That means if we do the math, she's getting charged $60 in interest for the month. Now, Coco has a savings account of $1,700 because she needs that emergency fund, right? She has an APY of 2%, so she gets 2% when she has the $1,700 in her savings account. So it gets her about $2.50. That means if we're adding everything up, if she's getting charged $60 in interest, but then has the $1,700 in her savings account and is getting about $2.50 for having money in the savings account, that means she's losing $57.50 every single month just by having this emergency fund and having that debt. Now, if we use our savings to put onto the credit card, let's see what the interest would be. So if we were to do that, the numbers would read as we have the debt of $2,925.72, and we're going to put $1,700 on there. So when we do that, it equals $1,225.72. So that's what's going to be charged for the interest. So if 25% of $1,225.72 is charged, we're looking at about $25 of interest just because they applied the savings, the $1,700, onto the credit card. This gives us a savings of $32.50, all because we didn't hold on to the $1,700. We used it to try to pay off the debt. So this is just a little knowledge. You cannot save money if you have a debt. What you have to do is invest your money. You have to either A, invest it by chunking it all at the debt, or B, investing into something that's going to give you a higher return than the debt. Now I'm gonna let you know here, 25% interest rate, there's nothing you can invest in that's going to get you a higher return. So in this scenario, your investment should be in paying off of that debt quickly. Now I know a lot of you guys are saying like, Charles, so what are you going to do for the emergency fund? You just use your credit card. So what we want to think about is the $1,700 that you put onto the credit card, that money is not lost. That money is just transferred from your savings account to the credit card. So if you have an emergency, let's say your tires got flat, you can just go to the tire place, and I'm pretty sure they take credit cards. You're going to swipe your credit card and you're going to use some of that $1,700. So again, this makes no sense of holding on to $1,700 when it's charging you $60 every single month. You need to apply that $1,700 to your debt to lower the interest to 25. So in this case, when Coco thought she was saving money, she was actually losing money by putting it into the savings account. Now, I do go over why banks want you to put money into the savings account. It's one of my first videos, Only Dummies Save Money. So go ahead and click on the link down below if you want to just educate yourself a little bit more. All right, so let's get into what everybody came for. We will be velocity banking in the Aloha state today. All right, so we're just gonna get into it. We have Miss Coco. Her income is about $27.48 per month. Expenses $13.28. Cash flow $14.20. So that's the income minus the expenses. And then we have her savings account of $1,700, and we talked about that. Why she shouldn't have any savings as of right now. All right, and she's trying to pay off her 2 credit cards. We have the Hawaiian card of $29.25.72 with the interest rate of 25%, and the minimum payment she has to make is $200. And she has her Citi card, which is $5,376. The interest rate right now is 0%. So we have an asterisk right here. She did a balance transfer of her debt onto the card. So as of right now, she has 0% for I think about maybe a year. A thing to note about the balance transfers. When you do this, you are unable to use the card. Because if you use the card, then they'll start charging you interest. So this will be an interesting scenario because we cannot velocity bank with that Citi card, because once we use it, the interest will go back to its normal rate. So the minimum payment on there is an $89 minimum payment that we have to pay on the Citi card. Now let's look at her expenses. So we have rent, which is $900, and the rent is actually going to be including all utilities. So she has a couple roommates and they all split the rent and all the utilities. The internet bill is $20 per month. Phone bill is $65. Citi card, like we mentioned, at $89 minimum. Have the Hulu of $13.99. And then groceries average about $40. And then we have the Hawaiian credit card of the $200 minimum that she would have to pay on there. All right, so let's get down to business. We should have both of these cards paid off or close to being paid off by the end of September. So for the month of June, remember her income is $27.48 for the month. So what she needs to be using for her cash is the rent is going to be $900, where she's going to have to use the cash to pay that. The internet bill will be $20 as well that she's going to pay in cash, along with the Citi credit card. She's going to pay the minimum of $89 for in cash, and then the phone bill $65. That's going to equal a total of $1,074. Now, quickly, I know some of you guys are going to say, hey, Charles, but it looks like this client can pay some of this on their credit card. And that is correct. Usually I would say, hey, you need to pay your internet and your phone bill on a credit card. But with this client, since she has roommates, she actually gives them the cash because the internet and the phone is in somebody else's name. So we can't use the credit card. So this is why these two things are getting paid in cash. So I want you guys to get that clear understanding. So once she pays all of these expenses using her cash just from the checking account, the leftover money will be $1,674. Because remember, her total income is $27.48. She's only using $1,074 of her cash to pay these ones off. Now the expenses that she's going to pay on her credit card, and this will be on her Hawaiian credit card. Remember, the city card, since it has a balance transfer, we cannot swipe that card or else the interest will start accruing. So the payments that she's gonna make on credit card is the Hulu and groceries. So she's gonna pay the Hulu bill with her credit card, her Hawaiian credit card, and the groceries with her Hawaiian credit card. Now, remember, the debt of the Hawaiian credit card was $29,2572. If we add both of these together, her balance for the Hawaiian credit card will be $29,7972 after she pays these two expenses on her credit card. Now, what we are going to do for this month, we're actually going to pay the Hawaiian card off fully. And what we're going to do, we're going to use the spare money, so that $16.74, the cash left over, she's going to apply it to her Hawaiian card. Plus, she's going to apply her savings account. So the difference between the $16.74 and the $29.72 will be $13.0572. So she's going to pull most of her money out of her savings account, remember it's $1,700, and apply it towards the Hawaiian card as well. This pays the Hawaiian card off in full. Now remember, when we pay something off in full, it increases our cash flow. So if we look up here, our expenses, instead of $1,328, they get minus by $200 because that was the minimum we had to pay on the Hawaiian card. And when the expenses go away by $200, that means our cash flow goes up by $200. So since we paid the Hawaiian card off in full for the month, we increased our cash flow by $200. Now, she still has some money left in the savings account because she only used $13.05 on the savings account. So she's going to use that spare money, the leftover money from the savings account, she will apply it to the city card. So when she does that, the leftover balance of the city card will be $4,981.72. So a recap of June. We have paid the Hawaiian credit card off in full. And the way that we did that was we used our spare money, the cash left over after she paid all her expenses, plus the savings account that wasn't doing anything for us. And she applied all that money and paid off the Hawaiian credit card, which that means that there was no interest charged and we increased our cash flow by $200. All right, so we're gonna move in the month of July. And we see this arrow, it's because it's going to be the same exact thing as June. So if we look, when the money drops to $27.48, now remember, obviously she's not going to get that full income all at once. So you are going to be doing a juggling act. So if she gets paid bi-weekly, the first check that drops, she will be paying her rent, her internet, city, and phone. And then the second check that drops, she's able to save it. So you're going to have to coordinate from what's due and what's not. But the basic concept is the income drops in $2,748. She's going to pay the rent, internet, city, and phone in cash. This leaves a leftover amount of $16.74 of her cash. Now, what she's going to do, she's going to pay her expenses, the rest of the expenses, the Hulu and groceries, with her Hawaiian credit card. This leaves a balance on the Hawaiian credit card of $53.99. So now what she's going to do with the spare money, she's going to apply the $16.74, because that's the cash that's left over, onto the city credit card. So we're going to be left with a balance of $3,307.72. So let's recap here. July, we paid majority of our expenses in cash. which left us a leftover amount of $16.74. The other expenses, the Hulu bill and groceries, we used our Hawaiian credit card. Because remember, we cannot use the city credit card because it has a balance transfer. And if we swipe that card, the interest starts to accrue. We don't have the 0% interest. So we want to keep on to that. So we're using the Hawaiian credit card as our banking account in regards to swiping things on there. Now we're on the month of August. Things are going pretty fast, but it's still pretty repetitive here. So in August, we are going to pay our rent, internet, city, phone bill, and our Hawaiian credit card, because remember, we have to swipe it in July for Hulu and groceries. So we're going to be paying off the Hawaiian credit card as well too. So our expenses for cash is $1,127.99. This leaves a leftover cash of $16.20 that we would have on hand. So pretty much what we're going to do with the Hulu and groceries, since we paid the credit card off, we're going to put Hulu and groceries back on for this month. So it's still going to be repetitive here, where we're going to pay the Hulu and groceries with the Hawaiian credit card. This is going to leave the Hawaiian credit card balance again at $53.99. Now all we're doing is taking our spare money from this step and we're going to apply it to the city credit card. So we still have not used the city credit card because of the balance transfer, and we're paying it off. So now the balance is $1,687.71. All right, so we're in the last month, we're in the home stretch, and we almost have this card paid off. So again, it's really repetitive. So September, we're going to be using our cash to pay the rent, the internet, city, phone bill, and the Hawaiian credit card, which equals a total of $1127.99. This is going to give us a cash flow of $1620. Now, for the Hulu and the groceries, we are going to be paying with our Hawaiian credit card just like normal. So since we've paid it off on the first step and then we reused it, the balance is going to be $53.99 yet again. Now we're at the third step. We are going to use the spare cash, the $1620, and we're going to apply it to the city credit card. And when we do that, we get left with a balance of $67.70. So we pretty much almost have this card paid off by the end of September. Now, just a quick note about my client. So my client does have student loans, but with the student loan forbearance coming into place for all federal loans, pretty much you do not have to pay the loans, and they're not accruing any interest until the end of September. So our goal was to try to get both credit cards paid off before the student loan comes about, and we will be tackling velocity banking on the student loans to get those paid off very quickly. So we pretty much accomplished this goal. Now, with this particular strategy here, there were a couple of complications that we had to overcome that we would normally not be doing. So number one, just to recap, with the internet and the phone, we are usually going to use our credit card to pay those expenses. So we try to pay most of our expenses on the credit card and then pay the credit card off. Since my client has roommates and she has to give them out cash, then this is the reason why we are seeing the internet and the phone bill being used and being paid off in cash. The second hurdle that we did have to overcome is the balance transfer for the city card. So we were unable to use velocity banking on the city card in regards to paying the city card with your cash flow and then using the money to pay the expenses. Because once we use our city card for expenses, that balance transfer of the 0% that we have is going to start charging us interest. So we were unable to use that. So I know you guys' notepad is probably filled up. Go ahead and rewind the video if you need to in regards to get the understanding of this client's particular needs when it came to velocity banking. And if you guys are looking for velocity banking coaching, go ahead and visit my website. We offer a lot of coaching services that tailor to your specific needs like we did for Miss Coco here. And always remember too, if you love these videos, go ahead and subscribe if it's your first time. Hit the like button, help stimulate that like button. It really does help the YouTube algorithm. It helps me reach a wider audience base as well too. And please remember to leave a comment. So again, I'm sorry that it's Saturday that I had to drop the video. You will catch me next week on Friday, bright and early, I promise. And I hope you guys have a good Memorial Day weekend. Peace out.